Hey everyone, I'm Cindy and you're watching another episode of Dress to Invest. Last week, we took a deep dive into credit scores. We discussed the factors that comprise them and what you're being judged on. Today, I'm going to show you how to put this information to use, and we'll discuss what you can do to improve your score. As a reminder, a credit score is a number given to anyone who uses credit. The score ranges between 300 and 900 and is dictated by a credit bureau. In Canada, that's either Equifax or TransUnion. These credit bureaus follow rules that define who can see your credit report and how they can use it. So if you're wondering who's got their peepers on your credit report, the list includes banks, credit card companies, car leasing companies, retailers, mobile phone providers, governments, employers, and even landlords. All of these businesses or individuals use your credit report to help them make decisions about you. And these decisions dictate whether they will lend you money, collect a debt, consider you for rental housing, or even for a job. The lower your score, the less likely you are to be approved for things like a credit card or a loan. And if you do manage to qualify despite a low score, the interest rate you receive will likely be quite high. So clearly, approval is only half the battle here. The quality of your score will also dictate the quality of the product you're approved for. But lenders look at more than just your credit score. Your income and other debts play a key factor in some lending decisions, as lenders consider what you owe alongside what you earn and the assets that you've accumulated. This is because your score alone has no way to reflect whether you can actually afford to repay the credit that you're applying for. So what's a good score? Let's review the breakdown based on Equifax's scoring model. At the bottom of the spectrum, your credit score is labeled as poor, and unfortunately indicates a significantly damaged credit history. If you find yourself in this category, it's likely due to having defaulted on multiple loans, carrying debts that max out or exceed your limits, or from declaring bankruptcy, which stays on your credit report for 7 years. In this range, you'll likely have a difficult time obtaining any new credit. Next on the scale is considered below average. When you're in this category, your odds of credit approval are higher, but you're also more likely to be faced with higher interest rates on those products. Once your score hits the high 60s, you're kind of sitting in credit limbo. You'll still have a lot of eligible options available to you, but might find yourself having a trickier time getting approved for something like a mortgage, especially at a competitive rate, and especially if your debt to income levels are quite high. According to loanscanada.ca, the minimum score needed to get approved for a mortgage in 2020 ranges between 620 and 680, depending on the lender. Next on the scale is considered very good. Congrats! If you're sitting in this category, you get to enjoy some of the best financial products and interest rates available. To have a very good score means you're generally financially responsible. You make most of your payments on time with only the rare occasional late payment. Chances are your credit utilization ratio is also pretty low. And overall, you're unlikely to have any difficulty obtaining most credit products and loans. And finally, at the top of the scale, it's party time because your credit score is excellent. As reward for your fantastic credit management, you enjoy rapid approval for credit card and loan applications, as well as high credit limits, access to premium and lucrative credit card rewards, and the lowest interest rates available on these products. In other words, all the financial doors are open to Canadians with excellent credit scores, and the banks roll out the red carpet to get your business.
I'm so honored to be here today to accept all of your credit, cashback, and rewards. I want to say a special thank you to me and my willingness to pay my bills on time, my balances in full, and especially to my credit utilization ratio. I'll never max you out, and I couldn't have done it without you. Thank you so much. Thank you. Thank you so much.
Chances are, if you're watching this episode, you're still on the other side of that red carpet. So let's dive in and talk about what you can do to cross the velvet rope. Based on what we learned last week, we know that bill payments account for 35% of your credit score. So the number one golden rule for improving your credit starts with ensuring that your bills are paid on time every single time. Late payments can really bring down your credit score. Just one late payment could have a significant impact on your credit, especially if you have a higher credit score. According to data provided by FICO, a 30-day delinquency can cause as much as a 90 to 110-point drop on a credit score of 780 for a consumer who has never missed a payment on any account. Yikes! Talk about getting the red carpet pulled from under you. So what can you do to make sure that your payments are made on time? Number 1, automate your payments. We're all human. Even the most well-intentioned people will forget things. But you can completely eliminate all chances for human error by just putting this on autopilot. Online banking makes this incredibly straightforward, so there really isn't any reason to miss another payment deadline. Number 2, write down and track all due dates. Especially if you're going to automate your payments on a monthly frequency, it's important to note that simply choosing one day of the month to pay all accounts might still result in a late payment. You have to pay attention to when the bill is actually due. For example, if you choose the first of the month, you may very well be paying what's owed, but if the actual deadline is the 28th, with statement dates beginning on the 7th, it's true that you're paying it before the end of the cycle, but still after the due date, so pay attention to that one. The next best way to improve your credit is to reduce your credit utilization, since this accounts for 30% of your score. Obviously, the simple way to do this is just pay off your debt balances. But depending on how much debt you're dealing with and the rate at which you're paying it down, this could take a significant amount of time. There is another way to lower your credit utilization, and if you're flirting with a very high ratio, this might be an option to consider if you're determined to improve your score. You can instantly lower your ratio by simply increasing your credit limits. But, and I can't stress this enough, if you ended up in the position that you're in due to lack of financial self-control, increasing your credit limits could essentially be opening Pandora's box for you. This is only a good idea if you know for certain that it doesn't pose a temptation to keep racking up further debt. Done correctly, increasing your total limits while continuing to pay down your balances will significantly improve your ratio in a much shorter period of time. The ideal is 30% or less, and once you hit that mark, you'll definitely see the benefits reflected in your score. After implementing the previous 2 steps, you're already well on your way to improve your score. But as you pay off your debts, resist the urge to close those credit accounts right away, because keeping paid-off credit products open not only maintains a strong credit history, but it will also continue to keep your credit utilization low. Think of it this way. Let's say you have 2 credit cards, each with a $5,000 credit limit. One has a balance of $3,000 and the other a balance of 0. This works out to a 30% utilization. But the moment you close the card with a $0 balance, you've immediately doubled your ratio to 60. So if you have paid off cards with a long-standing history of good credit behavior, high limits, and no annual interest fees, it's likely in your best interest to keep these accounts open until you've paid off all your other debts. Another way to maintain a good score is to avoid unnecessary credit inquiries. Soft credit checks, such as when you check your own report, won't affect your credit score. But hard credit checks, like when you want to increase the limit or apply for a new credit product, will have an impact. A couple hard inquiries isn't going to destroy your score. But if you've been applying for a lot of credit in a short period of time, this is going to raise a red flag to lenders. It sends a signal that you're potentially in financial distress and about to take on a lot of debt, and this paints you as a larger risk. Another situation in which credit inquiries could pose a lot of damage is if you engage in credit churning. This is when an individual attempts to rack up cash back and other rewards by applying for multiple credit cards only to take advantage of the sign-up bonuses offered in the first few months, and then canceling these cards when the bonus period expires. This practice can be unkind to your credit score, as each time you apply for a new card, it can potentially take up to 10 points off. And since you're canceling the card shortly after, you're not going to benefit from building any additional credit history or reducing your credit utilization. Finally, another great way to improve your score is to actually check it. Pay attention to your score and make sure to review your full credit report. Just being cognizant of your numbers, just as with managing your cash flow, is the first step to making progress because you've made yourself aware of where you stand and what you're working with. And according to a report released by Borrowell, there is a statistical correlation between regularly monitoring your credit report and improving your score. But more importantly, monitoring your report will let you know if there are any open credit lines in your name that shouldn't be there, which might indicate a case of fraud. If you catch something fraudulent, make sure to dispute it right away, and with both credit bureaus. Waiting too long can erode your rights to dispute the fraudulent activity on your account. So there you have it, a full arsenal of tips to get yourself onto that credit score red carpet. Join me next week for an episode of DTI Real Talk, where I take you on an up-close and personal look at how I've managed my own debt and the specific tools and strategies I've implemented to make it all a breeze. In the meantime, if you're wondering how you can check your credit score, you can visit the links provided in the video description below. But before you go, make sure to subscribe to the channel and share what you've done to improve your own credit in the comments below. And I know that you know someone who needs to hear this, so go ahead and share this video. Thanks for watching, guys, and we'll see you next week.